everyone, welcome back to Canada Accounting Insights. Today we're diving into leases from the lessor's perspective. If you've already watched our video on lessee accounting, you'll remember that leases can get pretty technical. But don't worry, in this video we'll walk through how lessors record leases under IFRS and ASPE, when a lease is finance or operating, how to account for manufacturer and dealer leases, and we'll even cover sale-leaseback transactions and disclosure requirements. And before we jump in, don't forget to like this video, subscribe, and hit the bell so you never miss future accounting insights. All right, let's get started. When we talk about lessor accounting, we're looking at things from the perspective of the company providing the leased asset, not the one using it. Just like in any business transaction, both sides, the lessor and the lessee, have their own accounting treatment. So while the lessee focuses on recognizing a right-of-use asset and lease liability, the lessor has to determine whether the lease is a finance lease or an operating lease. This classification determines everything that follows, from revenue recognition to asset derecognition. Let's start with how to classify the lease under IFRS. A lease is classified as a finance lease if it transfers substantially all the risks and rewards of ownership to the lessee, even if legal title doesn't pass. There are 5 main classification criteria. 1. Title transfer. If ownership automatically transfers to the lessee at the end of the lease, it's a finance lease. 2. Bargain purchase option, BPO. If the lessee can buy the asset at a price below fair value and it's reasonably certain they'll exercise that option, again, it's a finance lease. 3. Lease term. If the lease term covers a major part of the asset's economic life. 4. Present value, PV of payments. If the PV of lease payments is substantially all the fair value of the asset. 5. Specialized asset. If the asset is so unique that only the lessee can use it without major modifications. If any one of these criteria is met, it's a finance lease. If none are met, it's an operating lease. Let's look at 2 examples. Example 1, finance lease. On January 1st, Summit Equipment, an equipment manufacturer, leases machinery with annual payments of $80,000 due at the beginning of each year, a 6-year term, a guaranteed residual of $25,000, implicit interest rate of 5.4%, and a fair value of $460,000. The equipment's useful life is 8 years. Here's how Summit analyzes it. No title transfer, no BPO, but the lease term is 6 of 8 years. That's 75% of its life. The PV of lease payments is about 96% of the asset's fair value. Since criteria 3 and 4 are met, this is a finance lease. Example 2, operating lease. Now imagine Prime Industrial Co-owner, also an equipment manufacturer, leases an asset with 2-year term, $60,000 annual payments, implicit rate of 6.9%, and a fair value of $250,000. The equipment's life is 10 years. The lease term is only 20% of the asset's life, and the PV of payments is less than half the fair value. None of the criteria are met, so it's an operating lease. Okay, so now that we know how to classify leases, the next question is, what happens after we've identified a finance lease? Let's walk through how lessors measure, record, and recognize revenue under IFRS. When a lease is classified as a finance lease, we have 2 possibilities. 1. The lessor is a manufacturer or dealer, or 2. The lessor is not a manufacturer or dealer, like a finance company. Let's break these down. 1. Manufacturer or dealer leases. In this case, the lease acts as a sales transaction plus financing. The lessor recognizes both revenue from the sale and interest income over time. At the start of the lease, the entries look like this. Debit lease receivable, the net investment in the lease. Debit cost of goods sold, credit revenue, credit inventory, or equipment. After that, the lessor earns interest income each year using the implicit rate in the lease. Let's make that concrete. Example, manufacturer/dealer finance lease. On January 1st, Global Equipment Corp. leases machinery with these terms. $80,000 per year for 6 years, paid at the beginning. Guaranteed residual $25,000, implicit rate 5.4%, cost $345,000, fair value $460,000. The PV of lease payments plus residual is $440,796. So, Global recognizes debit lease receivable $440,796, debit cost of goods sold $345,000, credit revenue $440,796, credit inventory $345,000. Each year, it recognizes interest income on the outstanding lease receivable. 2. Finance company leases, not a manufacturer, dealer. When the lessor is a finance company, there's no sale or cost of goods sold, just a financing arrangement. The lessor removes the asset from its books and records a lease receivable. Debit lease receivable, cost minus initial payment. Debit cash for first payment. Credit equipment at cost. Then, over time, debit cash. Credit lease receivable, credit interest income. Example, finance company lease. On January 1st, Everest Leasing Inc. leases equipment costing $256,790 for 5 years. Payments are $55,000 per year starting immediately, with a guaranteed residual of $15,000 and a 6% implicit rate. The entry at commencement is debit lease receivable $201,790, debit cash $55,000, credit equipment $256,790. Each year, interest income is recognized on the outstanding receivable. Eventually, every lease ends. So, what happens when it's over? The lessor derecognizes the lease when its right to cash flows expires, usually at the end of the term. If the asset is returned, the lessor recognizes it as a new asset under IAS 16 property, plant, and equipment measured at fair value. Depending on the residual value, there might be a gain if the fair value is greater than expected residual, or a loss if it's lower and unguaranteed. Example, end of lease scenarios. Let's use North Point Leasing Company and Orion Industries. At the end of a 10-year lease, the residual was expected to be $15,000, the BPO was $10,000. If Orion exercises the BPO, North Point records debit cash $10,000, credit lease receivable $10,000. If Orion doesn't exercise and returns the asset worth $15,000, debit asset $15,000. Credit lease receivable $10,000, credit gain $5,000. If the fair value were only $12,000 instead and no guarantee, debit asset $12,000, debit loss $3,000, credit lease receivable $15,000. So that's finance leases. But not every lease transfers risks and rewards. Many are much simpler. Let's move to operating leases. If the lease doesn't meet finance lease criteria, it's an operating lease. Here, the lessor keeps the asset on the books and recognizes rental income on a straight-line basis, even if payments vary. Example, uneven payments. A 3-year lease has payments of $80,000, $95,000, and $95,000. Total $270,000 divided by 3 equals $90,000 per year. Each year, revenue recognized is $90,000. Not the actual cash received. Lessor entries debit cash. Debit or credit lease receivable for timing differences. Credit lease revenue $90,000. Rent-free periods or inducements. Sometimes landlords offer incentives like 1 free month. If rent is $1,000 per month and the last month is free, the lessor records a prepaid lease inducement and recognizes $916.67 revenue per month over 12 months. Debit prepaid lease inducement $1,000. Credit lease inducement obligation $1,000. Then each month debit cash $1,000. Credit revenue $917. Credit prepaid inducement $83. And in the last month debit lease inducement obligation $1,000. Credit revenue $917. Credit prepaid inducement $83. On the statement of financial position, finance leases are shown as lease receivables, split between current and non-current. Operating lease assets are shown under PPE or investment property, depending on the nature of the asset. Disclosures must include a general description of leasing activities, how risks are managed, and maturity analyses of lease payments for both finance and operating leases. For operating leases, lessors must also disclose income from leases, variable lease payments, and future lease receipts for at least 5 years. Finance lease disclosures include profit from sales, finance income, variable payments, and a reconciliation of undiscounted payments to the net investment in the lease. A sale-leaseback happens when an entity sells an asset, then immediately leases it back. For example, Builder Co. sells its office building to Finlease Limited, then leases it back for 10 years. Under IFRS 16, the key question is, did a sale actually occur? If the seller has an obligation or option to repurchase the asset later, or if the buyback price is above market value, no sale occurred. In that case, the transaction is treated as a financing arrangement. If it's not a sale, the buyer-lessor doesn't record the asset. Instead, they record a loan receivable. Debit financial asset loan, credit cash. Interest income is earned using the effective rate. Example, not a sale. Evergreen Realty Corp. buys a building from Atlas Manufacturing for $2 million and leases it back for 10 years. Atlas must repurchase it for $2.4 million at the end. Because of the repurchase clause, this is not a sale. Evergreen records debit financial asset $2 million, credit cash $2 million. Each year, it recognizes interest income at 13.56%. At the end, when Atlas buys it back, debit cash $2,400,000, credit financial asset $2,400,000. If it is a sale, if control is transferred and there's no repurchase clause, then the buyer recognizes the asset normally and treats the leaseback as an operating or finance lease, depending on classification. Example, Crimson Inc. sells a building to Azure Properties Limited for $3 million, which equals fair value, and leases it back for 22 years at $134,600 annually. The lease term is 63% of the building's useful life, and PV of payments is only 58% of fair value. So this is an operating lease. Each year, Azure recognizes debit cash $134,600, credit lease revenue $134,600. Now let's compare IFRS and ASPE. Under IFRS 16, we have finance and operating leases. Under ASPE 3065, we have sales type, direct financing, and operating leases. A sales type lease, ASPE, is similar to a manufacturer-dealer finance lease under IFRS. A direct financing lease, ASPE, matches a finance company lease under IFRS. Under ASPE, a lease is capital finance only if it meets all of these conditions. 1. It meets at least one of the lessee criteria: transfer of ownership, BPO, 75% of life, or 90% of fair value. 2. The credit risk is normal. And 3. Non-reimbursable costs can be reasonably estimated. If these aren't met, it's an operating lease. Example, ASPE lease. Forbes Equipment Limited leases specialized machinery costing $280,000, fair value $315,000, for 5 years. Useful life, 8 years. Annual payments, $57,000 plus $3,000 maintenance, guaranteed residual $80,000, rate 8%. The lease term is 63% of useful life, so it doesn't meet the 75% threshold. But since it meets the PV test and residual is guaranteed, this qualifies as a sales-type lease under ASPE. All right, let's wrap it up. From the lessor's side, lease accounting depends on whether the lease transfers risks and rewards. If it does, finance lease. If it doesn't, operating lease. Finance leases can be either sales type, manufacturer or dealer, or direct financing, finance company. And under ASPE, the rules are very similar, just different terminology and criteria thresholds. Understanding this classification is key for CPA exams and for anyone analyzing financial statements involving leased assets. If you found this breakdown helpful, don't forget to like this video, subscribe to Canada Accounting Insights, and share it with your classmates or colleagues preparing for the CPA exams. And as always, thanks for watching, and I'll see you in the next video.